Hi, I'm Jim Yent from Golden Years, the home of the Kairos formula. It's Friday the 13th. Ooh, hope things are going well for you, but there's been a lot of economic news that we want to give you a quick update on. As always, we love to do our speedometers from our partner, City National Rockdale. So let's look at the January speedometers first. In December, we actually lost 2 green indicators and lost 1 red indicator. So if you look, here's our January speedometers, and there's a lot of yellow on the screen of the 20 indicators. Yellow doesn't mean bad, it just means neutral. And since so much is yellow and there are no greens, it means there's a lot of uncertainty out there. Where we lost the 2 green indicators is in the second line, the second one over, the labor market and consumer spending, both ticked down from a green, so that they're now in the yellow. And probably more importantly, if we go to the bottom line, the lower left corner, inflation was a red and is now finally in the yellow. And that's good news. And it's because of a lot of things that are happening as recent as yesterday. Yesterday, we had an inflation report, the consumer price index, and the chart on the right shows you that blue line. CPI now is going down. And plus, the Fed looks at another measure called CPE, which has been going down for 6 months. And if we look to the left, headline inflation for CPI went from a 7.1 number down to a 6.5, great number. That's including everything that the consumer sees. Core inflation is when they subtract out the 2 volatile things that change all the time. It's oil, gas prices, as well as food prices. And on a core basis, we went from 6 to 5.7, also good news. And if we look more recently at the 3-month average and annualize it and do a seasonal annual adjustment to that rate, inflation is dropped pretty significantly down to 2.2. So a lot of good news on that front. And probably more important from the Federal Reserve's perspective is they're concerned that we as consumers expect high inflation. And so there's 2 numbers that they watch, the 3-year inflation expectation number and the 5-year inflation expectation number. Both numbers came down, the 3-year down to a 3.0, and more importantly, the 5-year down to a 2.4. Remember, their target is somewhere around 2. So if we can have those inflation expectations held down, that's great. Meanwhile, actually more people are going back to work. We're back down to our historic low of unemployment. 3.5% of the population is what's unemployed from a measurement perspective. And probably as importantly, the Fed is also seeing, how easy is it to get a job? Is there too many jobs? Are the pay rates higher than expected? So there's something called the JOLTS reports, which is job openings. And that declined a week ago Friday, as well as hourly pay. People are still getting raises, but that number is coming down. The increases are getting smaller, which is what the Fed's concerned about, that you could create a wage price spiral. So if those expectations are falling, and as importantly, those increases are falling, then this may not be as long-term of a problem. So they've made a lot of progress. What the Fed has done is working, without a doubt. What does that mean from a big picture perspective? I'm going to once again go back to the forecast that City National Rockdale does, because I think it's pretty easy to get our hands around it. And you'll see the blue bubble on the left. There's a green bar, a green curve coming down, which is this is where we are, the U.S. economy. And we've been saying for most of last year that the expectations are for 2023 is that the global economy could be in a recession. Europe, because of everything going on with energy and the war in Ukraine, and the U.S. would feel it too, and China with COVID issues. So a worldwide recession. So the odds of recession have been well over 50% for most of last year. And right now, just using the City National Rockdale numbers, they'd say it's a 75% chance of a recession. But what we've been trying to stress is the argument isn't whether there's going to be a recession, it's when and how deep. And whereas for most of last year, the feeling was the recession was kind of second quarter-ish. Some thought it was already happening, but second quarter-ish of this year or beyond. They also thought it would be a deep recession. And that was our concern. If it's deep, meaning just a normal recession where profits fall and the economy shrinks too. What we've been describing to y'all is what we call a growth slowdown a mild recession or a profit recession. And if you look on the grid on the right, that's what City National Rockdale is putting in that middle section, that yellow gold section. A mild recession is now the most likely case for many people. Goldman Sachs has reversed their estimates. JP Morgan just recently have reversed their estimates, saying this mild, meaning, yeah, the economy may shrink, but not much. It'll be more like flat, maybe, in the quarters to come for the first 1 quarter or two. But where we're going to see it most, and have already seeing it, is in profits. You know, the year before we had massive profits coming out of our COVID pandemic that were just monstrous. And so the year after, it's hard to have another really high year again. So for instance, we just started fourth quarter earnings. Today, banks announced their earnings, and they were positive, but they too are being cautious, conservative, and putting aside more money for any like bad debt or loans that might happen. But their earnings went up, not strongly, but up. So in general, when we look at fourth quarter earnings, the forecast is either flat to maybe a -1 or 2%. And often we overachieve. About 75% of companies beat their estimates on average, 70-ish, 75. And so we might just come out flat. So that now is the most likely case, a mild recession, which is what we're hoping for. Our comments to you was, if it's a mild recession, we may have seen the bottom and it's in our rearview mirror back last October. But our concern was, if this is a normal run-of-the-mill recession, then profits at some point will fall further. And if profits fall further, the market will test that October low, potentially could go even deeper. It's still possible, but it's becoming less likely as we proceed. So that's a quick update on what's going on. The 3 to 4 things that we're watching in this tactical short term are precisely what we said. We're watching the Fed. The Fed has told us that they're going to continue to raise their Fed funds rate. It's currently at 4.4. They said they're going to get it to 5 or slightly higher. That's what they're targeting. They meet next at the end of the month, January 31st and February 1st, and then they'll announce most likely another rate hike, because they're trying to get from 4.4 up to the 5-ish. So they went finally from 75 basis points down to 50 basis points. We'll see at the end of the month whether they do another 50 basis points, or because things are slowing and we're seeing it, maybe they go to a quarter point. So it's not if, it's just when. At some point, at one of these meetings, the Fed will drop from a 50 basis point to a quarter point. And then at some meeting, we don't know when, they'll actually stop raising rates. But they've told us their target is 5-ish, a little higher, somewhere around there. And then they'll hold it. We'll see. The market, if you look at all the Treasury yield curves, the market believes the Fed is wrong, that they're going to have to do smaller rate increases. And they believe if they make it to 5, they won't stay there for long. And so if you look at the yield curve, they're saying sometime second quarter, we'll see the Fed finally react. The truth, well, we all got to stay tuned to see. So that's one thing we're watching. And secondly, profits. We already told you fourth quarter, flat, forecasted -2, but kind of call it flat. We look at first and second quarter consensus estimates from analysts, same kind of thing, either slightly negative or flat. So we're going to have a couple of quarters, because it's that middle scenario, a mild recession. We're going to see the profits just be flat for those first couple of quarters. The expectations of analysts are over time, third quarter, fourth quarter, we start seeing growth again occur there. So that'll be key that we're watching on that front, and that'll drive markets. Because whenever the Fed finally slows down or pauses, and whenever profits hold, don't fall, or start rising, you'll watch markets react to that. Obviously, we still have our eye on everything going on geopolitically, whether it's things in Ukraine, in Taiwan, in Korea, as well as just at home politically. We think there could be some government shutdown fear going forward. But for now, markets are rising, and we got our eye on the ball. So stay tuned. We wanted to give you this update. Sorry, it's a bit longer than a normal one. And we're going to come out with our kickoff meeting, giving you the full picture of what's going on. Until then, we hope you have a great day. Take care.